Every investor dreams of finding the next suburb that's about to boom. But with thousands of data points out there, from yields to vacancy rates to sentiment scores, how do you separate the noise from the truth? That's exactly what my guest today has set out to solve. I'm joined by Dr. Matt Djolic, co-founder of HtAG Analytics, a software as a service platform that uses data science and AI to help investors and property professionals identify higher than average growth locations before everyone else catches on. Matt and I unpack how predictive analytics is transforming property research, what data really matters when forecasting growth, and why traditional metrics might actually be holding investors back. If you're the kind of investor who loves spreadsheets but secretly wishes they'd tell the future, this episode is for you. Let's dive in. Dr. Matt Djolic, thanks for joining me on Geared for Growth.
Thank you for inviting me, Mike. It's a pleasure, really.
From my perspective, a much anticipated episode because you've been a mover and shaker in the data space for quite some time, but I've been very tardy in getting you on the show. But thank you very much for coming on. I'm very excited to dive into the episode today.
No, absolutely. I mean, our paths have sort of semi-crossed a lot in the last year or so, and I've been speaking about you as well to some of the other people that I sort of associate with and been meaning to get in touch as well. So finally we are here. I appreciate it.
Beautiful. Well, let's start off with perhaps a little bit about your background. So we were talking a little bit off air, and it's interesting for us both to observe the property market because we are kind of off to the side compared to the ones that are transacting, the buyers agents and the real estate agents. But you obviously have a PhD. You're not a buyer's agent. You have a whole life that probably doesn't even involve property. So give us the elevator pitch on that.
Yeah. I mean, it's my life is interesting. I sort of stumble into things, you know. It's funny. I remember, you know, when I used to work in corporate and people ask you, where do you want to be in 5 years? I don't have 5-year plans, you know. Yep. So I started off, I mean, as an investor. I worked as a senior level individual in construction and development companies. I was an estimator, then an estimating manager, managed a team of, depending on 5 to 10 people, which is very aligned with what you do. I mean, it's construction quantity surveying, essentially. That's what I was doing. Yeah. And I was doing that for years, and I was investing in property at the same time. I'm the type of guy who, you know, I wanted a plan B, and in order to learn property, I used to try to read every book under the sun. Back then, I used to attend, you know, buyer's agent seminars and stuff to try to, I guess, educate myself. Created my own spreadsheets and all of these things to analyze markets. And I realized at the time, you know, that about 15 years ago, even more, it was very isolated in a sense that you couldn't access data and information, especially trend data. You know, you can buy your investment property magazine, and at the back of the magazine, you would see, you know, isolated stock on market for this month. And I used to always ask myself, okay, how do I don't know what's going to happen tomorrow because I don't have the trend, you know. Yeah. And then started working on it for myself, met my co-founder, Alex. He was a software engineer at Westpac. And we started just building something for ourselves, you know, which eventuated down the track into a product. I enjoyed academia, so I did my PhD in organisational psychology. Again, something completely adjacent to, or not adjacent, I mean, completely separate to what I do now. But it did really help me because I was trained for 10 years essentially in data collection and data analysis, both qualitative and quantitative. So, yeah, I mean, and it's interesting that, you know, I'm good at pattern recognition, which you essentially need to be an estimator. You know, you need to visualize the project in your mind before it's built to understand how to price it, I guess. The second aspect of that in academia, I really know how to explain things in a palatable way, complex things. And when you merge those two together, I guess it really suits my job now, I would say.
Yeah, awesome. And we're going to put you to the test on explaining some very complex things throughout the show. So not that you need it, but I hope you've had your Weet-Bix regardless. Let's talk about the product that became HtAG. For anyone that hasn't come across it or doesn't use a platform like that where you can basically grab data and analyze those trends for a myriad of different data points, can you explain sort of how it comes together and how it works?
Yeah, absolutely. Now, you know, what we realize is that looking at data, I mean, first there's an isolated view of data in a sense that you can look at information from, you know, this month perspective, etc. So that really doesn't allow you to predict what's going to happen in the future. So you need to layer trends on top of that. But looking at data just by itself is essentially meaningless because data varies in meaning on the basis of the user. So what I mean is that we realize that you really need to connect the individual brief, the individual financial circumstance, and what they're trying to do to the appropriate data points to then execute a decision, you know? So, I mean, as I always say, we have 150 metrics on the platform, but having more metrics doesn't mean we have a better service. Now, what that allows us to do is to triangulate and look at suburbs or street levels from multiple points or vantage points, essentially, to understand the suburb better. And when you are approaching it from the individual brief perspective, you then have the ability, when you have more options to choose from, to know what really matters for you in order for you to make the right decision. So when it comes to HtAG, the flow, I would say, is a 3 or 4 step process. We initially have to define the purchase brief of the individual, and that's usually reflected in answering 5 questions. So what is your budget? What is your investment time horizon? When do you plan to, or when can you extract equity into the subsequent purchase, which requires you addressing your serviceability aspect as well as the growth momentum of the suburb. What is your risk profile? And which stage are you at in your portfolio building journey? Are you in the acquisition or the expansion phase, or are you in the consolidation phase? Because then that guides, are you focusing on capital growth or are you focusing on cash flow? And that information, the answers to those questions would actually dictate the research algorithm that you build. And what is a research algorithm? It's essentially a collection of data points that are necessary to be there for you to produce a discernible shortlist that matches your brief. And then you will go into detailed comparison, etc. Now, the interesting thing about this is that the brief defines the data points that you need to look at. Not only that, it defines their significance. So some data points are much more significant in a certain circumstance than others. To give an example, if I'm investing for cash flow, then things such as vacancy rates, rental increases, and yield are going to have much higher significance than potentially days on market, you know? So it is essentially building that logical narrative from metrics, connecting metrics into a narrative, a logical narrative that increases the probability of a particular outcome. Now, the layer of complexity that we have on the platform is that the outcome is no longer, you know, how much will I receive, you know, compounded growth rates in 10 or 15 years. If you want to build your portfolio, you need to understand market momentum at different time frames. So short term, mid-term, long term, and you need to layer the information appropriately, again, to increase the probability of you achieving those growth targets at different time frames. So, and this is why I think I always say it's one thing to see figures on a page, yet another thing to understand the story that they tell. And it is for this reason explicitly that we decided, well, it's not sufficient to have HtAG as a platform, as a proptech. You also need to have the layer of explainability and education for users to know how to use data and interpret it, which is why we have a mastermind community in addition to the platform to buttress and supplement that entire process.
Yep. And that was going to be my next question. Is kind of the strategy and all of the execution of where we're at and what we're trying to achieve, is that traditionally the role of a buyer's agent who helps the client go through it? Or can a client come to your platform, provide that information prompted by you, and then the algorithm kind of works for their specific requirements?
So yeah, it's a good question. Now, our users are both buyer's agents and investors. Buyer's agents have a more proclivity towards data and information because they use it every day. So I think the absorption and the learning curve is much shorter. And buyer's agent would also, let's say, ask their client regarding their brief and all of these other things, and they will use that information to then structure the data in the appropriate way. However, we also have investors that use the platform, and that's actually been increasing as years go by, because I do think that the market is changing in a sense that investors also want to educate themselves, you know, and some of them want to go and do it themselves, essentially. So the investors will also go through a training process where they really understand what the brief is, where they really understand what equity extraction or growth targets are, and all of these other things, so they can use the data in the most appropriate way. Now, the learning curve is a little bit steeper there, but, you know, there are methods in place and processes that really assist them to absorb that.
Yeah, I guess where there's a will, there's a way, right? And there will be people that are happy to dedicate the time to it. I'm interested in some of the stuff that I guess you would see that happens under the hood that might be, proprietary information you can't share too much about. But I'm interested in your observation of how people are using the platform. Are they sort of stopping at one or two metrics? Are there people that just dive into everything? I mean, I've seen you share, I think they were word clouds for particular suburbs. So that gives a fairly good finger on the pulse of what's of interest to buyers, agents, and investors at any particular time. Are there any insights that you can share in terms of the way that you observe people using the platform?
Yeah, so essentially there is a method and a process that everyone goes through. Mm-hmm. Now, everyone starts that method and process with different, preconceived ideas. And I guess I would say a lot of people have the same preconceived idea. The first one is, I would say, people tend to approach investing from an isolated analysis of a suburb. They always come to me and say, what do you think about this suburb? And a big part of my, job at HtAG is changing mindsets, essentially. I always say you can't look at things in isolation because things in isolation do not have meaning at all. I mean, because something is bad, it's bad because there's something that's good, essentially, philosophically, So I always force them or nudge them to actually do a detailed comparison to have a better view of how things look. Because a days on market in a particular suburb of 25, essentially that is not inherently good or bad. It is based on your brief and it's based on the days on market of other suburbs for the same brief. Yeah.
So that's a very good point.
Yeah, and that's why comparison is imperative. Now, the second thing that users tend to do is they tend to assign the same significance to everything, right. And that's very important. Now, for example, if you're looking at a suburb from 30 metrics and you assign the same significance to all of these metrics, it's like assigning no significance to all.
Yep.
It is exactly the same thing. Now, what happens as a result is that you're getting average results and you're increasing opportunity cost. And what is opportunity cost? The cost of investing in a location that's not going to deliver like some other potential candidates. Yeah.
Yep.
So I think another education process that occurs is trying to educate the users to understand which data point is significant and why in response to their briefs. I think that's one other thing that I really spend a lot of time defining, because economics 101 dictates that reducing supply, increasing demand equals price growth. That's just economics. So there are certain metrics that have very high correlation to an outcome, i.e. growth of cash flow, capital growth, supply metrics, demand metrics. Essentially, they have a high correlation irrespective of the brief. Mm-hmm. But where things, increase in complexity is you can't really determine the performance output of a suburb at different timeframes if you don't layer additional data points on top. And then what do you layer? Why is that significant for you? What are you trying to achieve? So it is this embedded significance that varies that you need to educate the user on so they can use the information appropriately. I would say those are the two crucial things. The first one is looking at things in isolation. And the second thing is not understanding the significance of information that's in front of you on the basis of what you're trying to achieve.
Yeah, that's a very interesting point. And I do want to ask you about some of the particular metrics that correlate with growth a little bit later. But when you were sort of explaining, and I'm sure that this happens to you a lot, where people say, what do you think of Melton? What do you think about Bundaberg? And you see this on the forums as well. And it kind of made me think of a question that I get where it's like, what's the best property for depreciation? And then typically I'll explain a 1-bedroom apartment with 4 gyms and 8 levels of parking, and it's in a complex of 600. And they look at me like, that sounds like a terrible investment property. I'm like, yeah, it is. But it was probably a terrible question. Like, that's not the answer to the question you actually wanted, right? So, yeah. So when someone says, like, what do you think about Melton, for example, you're like, well, what do I think about? What do you want me to think about Melton? Like, is it going to grow in 3 months? Is it a 20-year play? Is it going to return cash flow? And is the cash flow going to outpace the capital growth? Without sort of an idea of the strategy, I'm guessing those questions must be frustrating to you.
Yes, so that's a great observation. Now, one thing that I dislike about I guess dislike is the harsh term, but I dislike it because it's leading people astray. So, I mean, social media is a beautiful thing in a sense that we can, communicate to everyone and, have larger exposure regarding our businesses, etc. But the problem with social media is that, and I'm going to go a bit negative here, is that everyone has an opinion.
Yeah.
Now, I don't mean that everyone shouldn't have an opinion, but it becomes crucial when it comes to expenditure of $500,000. Now, coming back to the question of what do you think about the suburb, the first thing that I ask is for who and in relation to what?
Yeah.
Those are the first questions that I ask. And usually, most of the time, what you see on social media is you say Townsville's a good investment location, but he never stipulates it's a good investment location for such and such a brief. If I have an equity extraction time frame of 1 year and I want the area to generate 20% growth in 1 or 2 years, then it's a good investment location. Okay. But if I don't want to do that, if I don't have the serviceability, if my equity extraction time frame is 4 years, then I need to move the needle and go somewhere else. Bottom line is, I think it's dangerous. And I mean, to the term hotspot, I don't want to use the term hotspotting because it has nothing to do with Terry Ryder. The term hotspot, I think, has done more damage to the industry than good. Because when you're talking about hotspots, you're inadvertently assuming that a hotspot is a hotspot for everyone. Now, imagine a hotspot that's $750K and you have only $350 to spend. What good is that information for me? So essentially, I think if we are discussing a suburb, we need to understand, okay, you're right. Is it cash flow? Is it capital growth? For who? In comparison to what? What are the timeframes? There are so many questions, but because social media gives us a limited window of explanation, you usually see promotions of areas without, and it's the same. It works same in inverse, in a sense that I remember when Perth was the flavor of the month.
Yep.
And I used to say something bad about, I would say I don't like Perth at a particular point in time for these reasons.
Yep.
People don't focus on me giving the reasons as to why. People just focus on the fact that I said that I don't like Perth. And I go,
anti-Perth.
Anti-Perth, anti-Perth. I caused a witch hunt on social media when I mentioned that. In the same way that I caused a witch hunt, essentially, when I mentioned Melbourne 2 years ago. And now Melbourne is the flavor of the month, But I mentioned Melbourne as a long-term, as a thing that's going to come online essentially in the next 2 years, et cetera, et cetera. So in a roundabout way, what I want to say is that it's essential to have the explanation as to who the area actually suits. And not every area suits us. And I mean, that's why budgets exist, Simply starting from a different budget base inadvertently implies you have to invest in different locations.
I remember a conversation with Terry where he kind of almost laments the title himself, the hotspotting thing, because really what he's trying to do is a little bit more like the sound of your business. He's like, well, I'm talking about locations that outperform the national average, higher than average growth. That's kind of what he's talking about, because a hotspot could be a mining town, and that's not something that either of you would talk about. But I wonder if the real estate investment market has changed. I mean, there's a lot of participants, even buyers agents that didn't exist pre-COVID, and there's this idea that everything always goes up. I think we've been kind of spoilt by Perth, because you were either in Perth and made a fortune, or you're on the sidelines wishing that you were in. There's probably some people that are buying now that might have a bit of pain, because we had 14 years of essentially a flat median house price. But I feel like once Perth kind of happened, the goal has now been to find the next Perth, and that's led people to Darwin, which is not a very diversified market. It's hard to argue against its performance. I mean, it's topping the charts with CoreLogic, but is that investor driven? Is that, domestic demand? It kind of begs the question, like, are we now in a period where every property investor is asking a question like, what do you think about Melton, for example? Because they feel like the brief is the same. I want 20% growth in the first 12 months, and I want to pay, less than 700K. And then we get this huge herd mentality where it's like, Mattia said, go to Darwin, or, go to Melbourne, and then the buyer's agents that follow, and then the people that watch them on social. And then suddenly we get these inflated markets that aren't really driven by fundamentals. Where do you land on that?
Yeah, it's great. There's so many things that you mentioned in there. Now, I do think that we've been spoiled by Perth. in a sense that, now there's an expectation of chasing those growth patterns. And I always say to everyone, you are bound by what the market gives you, in a sense that the market at a particular point in time, there might be a market that's returning 20% average for 3 years.
Mm-hmm.
And that's a hotspot. At a particular time, there might be a hotspot market that's returning 7% average in 3 years.
Yep.
So you're sort of bound by what the market gives us, and it's not replicated across.
Yeah.
So that's the first thing. The second thing is that not every market is suited for both short-term and long-term investment time horizons. And usually, I always use the example of, elastic band. When you stretch an elastic band, when your physical constitution can't hold it anymore too much, it compresses back. Mm-hmm. Now, the faster something goes up, the faster it also goes down, and the cycles are compressed. So it works in those ways. And with Perth, people believe that Perth is going to become a perpetual hotspot. It doesn't work like that.
Yeah.
So essentially, however, there are certain ingredients in all of these markets that need to be present to see reasonable price growth in the short term. Let's talk about Perth. Perth ingredients were, now it doesn't have to do anything with GCC, although most of the growth was seen in greater capital city regions. And this is a debate between, do capital cities return more than regional areas? And we can see between Perth and let's say Queensland, that Queensland regional was returning much more than Brisbane, essentially.
Yep.
So it doesn't really matter in that way. But what matters is that you need to have these ingredients. And I did receive an email 16th of November, 2023. I remember that email vividly. It was, Matt, I want to find the next Perth. Where do I go? And Townsville came up on the shortlist then, and then Townsville actually made phenomenal returns thereafter. But what were the ingredients? The ingredients were this: extreme affordability.
Yep.
Okay, which means that it makes it affordable for the owner-occupier cohort to participate. And if the price point is below 650K, you'll see migration of investors when the reflexivity starts kicking in the positive feedback loop. Yeah.
Yep.
And then you'll see investors and owner-occupiers competing for the same asset, which leads to exorbitant price growth. So affordability is one of the primary drivers of purchasing, especially for the owner-occupier cohort. The next thing is elevated socioeconomics. You had that in Perth, you had that in Townsville. When I say elevated in on a spectrum base. So let's say usually we have an ERSAD metric, which is socioeconomics. It's a score from 1 to 10, which is derived by ABS, by the way. Yep. So 1 and 2 would be disadvantageous. Everything above will be neutral and opportunistic. So when I talk about favorable socioeconomics, I'm talking about 3, 4, 5, 6, anything above 1 and 2.
Yep.
So you had that, and you had on top of that severe supply scarcity. Okay. And when you combine all of that, let's say if you have a situation where you have elevated socioeconomic standing, very high levels of affordability, but supply is scarce, that means that even small increases in demand lead to large material changes. And if the price point is below 550 or 650, where investors can participate as well, this is where you see exorbitant price growth. Now, coming to Darwin, it is interesting that Darwin, for example, it was coming up in our warm spot methodology shortlist, which you have on the platform for about a year now. Yeah. And me being, I essentially tell our users not to have bias to actually drive the decision making, disregard the suburb name, just make sure that the information stacks up. Yeah. And I was disregarding Darwin, and I did the same thing that I tell my users not to do. I had bias. Now, I always say this to users. Darwin, if you analyze Darwin has those ingredients like Perth. It has elevated, not all Darwin, by the way.
Yep.
Not all Darwin. Now, we're speaking about, essentially just a couple of suburbs, much less than in Perth and anywhere else. Right. You have elevated socioeconomics at very high levels of affordability and supply scarcity. Okay. Now, if you look, and now you are analyzing short-term performance of the suburb. Now, let's broaden our horizons. And let's analyze long-term performance. I went on a podcast the other day, and I was speaking about Darwin in positive sense, but I said this: Darwin is a 1 to 4 year play, because it has those ingredients. But I put a large question mark against its long-term endurance and lack of volatility because of its historical performance. And if I speak to a client, I would say, and let's say they want to invest in Darwin, I would say, tread lightly. Analyze the suburb or where you're investing at the 4 or 5 year mark and decide what you want to do. Now, at that point, we are already entering a little bit of speculation, because we need to assume that it's going to return substantially in the next 4 years for the sales and acquisition absorption cost to be palatable. Yeah.
Yes, that's the big one.
To be palatable. But I give all of this information. People need to know this. I'm not going to come out and say, just buy in Darwin. There are so many, and this is another thing I would say. When areas are promoted, they're promoted always in terms of pros. I rarely see a person say, these are the pros, these are the cons, this is how we're going to manage the cons. So in the context of Darwin, I'm going to manage its long-term steam by assessing its potential at the 4-year future mark, you know? So in essence, there are ingredients that are present that need to be economic. It's essentially economics 101 that are present before a suburb booms. But just because Perth has boomed and has delivered 30% average or 20% average annually doesn't mean that will happen in Darwin, number one. Number two, just because it returns in the short term substantially doesn't mean it will continue doing so in the long term. So you need to really consider your investment time horizons. You know, so there's so many different things that you need to really look at to decide where you want to go and what you want to do. And I guess finally, as a conclusion to this, you can't expect the same returns across every time frame in different locations. There are different dynamics, different push and pull tactics, and it is rare. I mean, in Townsville, you found the next Perth. Yeah, it delivered the same. Now, will Cairns do the same? No, it won't, but it will deliver a decent amount. Bottom line is, you're just bound by what the market gives you.
Yeah, yeah.
And
I haven't heard people talking about Cairns yet. Is that an exclusive?
Yeah, no. Well, Cairns, let's say some of our members invested in Cairns a year and a half ago, and now they generated 30% returns. That's already a substantial return, which means that they satisfied that short-term investment time horizon. Now the question is, okay, let's talk about long-term, and putting that aside, the job is to find the fastest horse, but the fastest horse where the returns that you make up front do not compromise the returns that you potentially will make in the future. And if you think that something doesn't have steam, you have to have strategies to address that.
Yeah, I mean, if you're on the fastest horse, this is going to be a clunky metaphor, but I'll give it a red hot go. If you're on the fastest horse, you need to bake in the time to do the pit stop after it stops sprinting to jump on the donkey that's dependently just going to charge along the next 20 years.
Exactly. And what are your then averages? Let's say I can invest. I'll give you an example. Emerald in Queensland, which is regional Queensland. Again, elevated socioeconomics for where it is, very high level of affordability, supply scarcity, improving demand, growth rate 12% in the last year. Great for short term, absolutely, because it has those ingredients. But Emerald is a huge concern long term because of its dependence on industry centralization. Yeah.
Yes.
So and if you jump from a horse to a donkey and you retain the asset in Emerald for 10 years, think about what your annual averages will be long term. And whether that's something, whether when you extract equity out of Emerald in the first 4 years, whether that asset is going to become a liability.
Yeah, that's a good point. I want to talk about maybe some biases that I have and some observations as well. Like it sort of seemed like a couple of years ago there was this term, data-driven buyer's agent, whereas now it's kind of like if you're not data-driven, you're not going to get the business, right? But what are we talking about when we're talking about data? We're talking about certain data points that have somewhat been debunked, like the correlation between population growth and house prices doesn't necessarily exist. It depends on a number of different factors, right? But my bias would say that the efficacy of the data is short-term focus. So, for example, things like vendor discounting or days on market or yield movements, these are fairly good indicators of short-term price movements. But once you go through that 10, 15, 20-year time horizon, they're somewhat useless. And we need to, if we're focusing on that time frame, we need to look at data points that might not necessarily be available to platforms. They're not easily absorbed. They might be that might be sort of a development control plan that is coming out from the council, or a 20-year infrastructure project that's still in the feasibility stage. I'm wondering on your thoughts, like are platforms like yours geared towards, or they're more effective in that 3 to 6 months, or do they have a story to tell in that longer time frame as well? The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Yeah, that's a great question. Now, this is where we come back to, the amount of metrics that you have on the platform. Now, what is interesting about HtAG is out of the 150 metrics that we have, I think over 50% have been exclusively developed by HtAG.
Right.
Like things like GRC index, GRC minima, for example. I'll explain what that is. Now, when it comes to property, the beauty of property is the fact that it's an illiquid asset. Mm-hmm. Okay. It means it doesn't exchange hands on regular basis, such as other asset classes, which means that when you have an established trend for something, that trend can be enduring to a certain point in time. Yeah. Mm. So, which therefore implies that the more, the larger historical timeframes you have in trends, it gives you more opportunity to peek into the future. Yeah. Yep. And potentially distant future as well. Now, there is a point because of recording mechanisms that peak into distant future actually ceases, let's say the 6-year mark or the 7-year mark. Yep. Now, after that 6 or 7 year mark, you have to use additional data points to ascertain probability. Mm-hmm. Okay. So what is the probability of an area actually falling off the cliff thereafter, Yep. Or what is the probability of an area continuing on its higher, annual average trajectory? And there are, again, because we're speaking in the context of probability, you can manufacture data points from a plethora of different indicators. So I'll give you an example. The GRC index on our platform looks at the historical growth rates of the area, mm-hmm. and calculates how many months historically, 3 decades back, the area has spent in the positive growth zone. Yeah. Yep. GRC minima, for example, stipulates what was the lowest point of negative growth in the past. Now, when you combine them together, it is a great volatility indicator, right? And endurance, okay? And now, because I'm speaking about probability, let's say we have a hierarchy of metrics on platform. We have level 1, level 2, level 3. Level 1, higher correlation to an outcome, more predictability. Level 2, a bit less. Level 3. GRC index and GRC minima will be a level 2 metric. It gives us a proxy of its historical performance and growth patterns across 3 decades, and it tells us, okay, what is the probability that something will continue into the future? Yep. So if an area is extremely volatile in the past, there is a higher probability that it will be also volatile in the future. Mm-hmm. If the area is not volatile at all in the past, there's a higher probability that it will not be volatile in the future. So yep. I always explain to our users, think about building a cake or making a dish. Essentially, you need the raw materials, and then on top of that, you sprinkle, essentially seasoning, So, and you can't have a dish without the seasoning, and dish is not just seasoning alone. So essentially, when your trends stop you from peaking into the future faster, you would then on top of that need to sprinkle on additional indicators such as the infrastructure spending, the trajectory of the infrastructure spending, the value of the project, the type of the project. Is it so? And then you combine it. I'll give you an example. If you have a very highly diversified industry in a particular suburb or area, and inadvertently you have very high levels of infrastructure spending, that is a great precursor for population growth.
Yep.
Okay. Now, conversely, if you have a very centralized industry and you have very high levels of infrastructure spending, that infrastructure spending is catering to that mining town, okay, for the mining project. And it doesn't provide you with long-term steam, i.e. it's not a precursor to population growth. So you can have certainty, you can't even have certainty short-term, but you can have very high levels of affordability. The more you go into the future, the probability dissipates a little, but at that time, you need to layer these additional macro factors or macro metrics to discern suburb A from suburb B, which one is more probable that it will be stable. And that's how you reach a decision. Now, this is why triangulation is important. You need to, I personally consider, when I look at a suburb, I consider 80 plus indicators, and I separate the indicators: short term, mid-term, long term, and I explain it. Short term, this is the probability of certainty. Mid-term, this is the probability. Long term, this is what it is.
Yep.
And you can go into the future, but we also need to remember that we're not dealing with certainty.
No.
The more you consider, the better. But nothing is essentially guaranteed. But I can tell you this: it is more guaranteed when I consider more than if I consider less.
Yeah. Yeah, that's a very reasonable statement. Yeah. I'll allow that one.
Yeah, exactly. So yes, it becomes, and I think where the space is moving as time goes by, you're going to have better recording mechanisms, more information accumulated, more pattern recognitions. We also use algorithms in the background to determine patterns, so is this metric correlated to that metric and why? And then you try to determine, what sits behind the relationship, and then you test that relationship across different time frames. You do all of these things. So, that are really robust mechanisms to determine certain things. But again, the aim, even when you develop these robust mechanisms, the aim is just to increase the probability. That's what you're trying to do.
Yep. It begs the question, though, in terms of those metrics, are there a couple that are your kind of go-tos that have a very strong correlation with price appreciation?
Yeah, there are. The first one is socioeconomics.
Yep.
I'll give you an example. If you're, and depending on the price point as well, which makes it again interesting and brief specific, So let's say if you're investing in markets that are below 550 K in value, socioeconomics does not play a dominant role in long-term and short-term price growth because you're inadvertently bound to invest in markets that are low or lower socioeconomic standard. Yeah.
Yep.
Now, if you're investing in markets that are 700K and above, socioeconomics plays a dominant role when it comes to short-term and long-term growth because there is 0% chance, 0%, okay, that a property or an area that has a 700K typical value will increase to 1.4 million in a decade with disadvantageous socioeconomics or an HtAG score of 1 or 2.
Yep.
Most of these areas have very elevated socioeconomics, a score of 7, 8, 9, and 10. So that's the first one. It's very important, which is why when we layer metrics on HtAG, we have a hierarchy that you need to address respective to the brief and the price point.
Yep.
Now, the second thing, which is common sense, is the affordability equation. Yep. Yeah. So the increases in property prices and wage growth are sitting at the highest disparity since 1970. Mm-hmm. And the disparity is so wide that it's a Grand Canyon. And when people think about it, if something is unaffordable to buy, the purchasing volume reduces. Yes. Now, if something is extremely affordable to buy and it's starting from a very affordable base, that means it has more long-term steam.
And so we can probably see that in the 23, 24 markets that did well, right? Like Perth was the second lowest median price after Darwin, and then it overtook Hobart and it kept going, right? But it's, Brisbane, Adelaide, Perth are the markets that have done the best in the last couple of years from a capital city point of view. And outside of Hobart and Darwin, they were the most affordable, right?
Exactly. And now it's not only that, it's in combination with affluence, as I mentioned, with socioeconomics. So it gives you more essentially purchasing power. And then finally, it's supply and demand. If you have supply scarcity and increasing demand, again, I never speak in terms of guarantees, but you're as close to a guarantee as possible. Mm-hmm. It's as simple as that. It's a simple equation. Now, when it comes to its momentum, its forcefulness, it comes down to how much, what is the supply scarcity and how it's been tracking across timeframes. Now, for example, on our platform, and I think it is rare. I think we're the only ones that have supply and demand trends spanning back 5 years. Yeah. Yep. And because of the liquidity of assets, you can sort of infer what the supply and demand will be at least 3 years into the future, because it takes a long time to really reverse a trend. Yeah, and usually supply in 1 month, then increases in the second month, then it drops, then increases, then it drops. You don't really see substantial increases all the time. Yeah. So that's why it takes a long time to reverse a trend. So when you really couple, the affluence, the affordability, as well as long-term supply and demand trends, you can come close to certainty as much as possible in the 1 to 5 year time frame. Mm-hmm. Now 5 year plus, HtAG socioeconomics and affordability still play a role because of steam effect. If you're starting, as I said, from a very, very, very high base of affordability, it has long-term esteem essentially, which is what's happening in Townsville. Townsville has been delivering above 10% growth for the last 8 years.
Yeah, right.
Yeah.
Wow.
So if you look at Townsville and you see in 8 years it's delivered 85%, this is essentially 7% more than Australian average. Because it's 5% average, you know what I mean? So it is because it started from that very, very high affordability base, So I would say, if I had to, and then finally, one thing I forgot to mention, when it comes to stability and endurance and lack of volatility, there's two domains. It's the economic domain and environmental domain. The economic domain is separated into industry diversification as well as dominance of mining and agriculture. And then you have the environmental domain, which is exposure to flooding and bushfires. Now, let's consider why. So if you have usually towns that are extremely centralized, like Gladstone, for example, they can experience enormous pumps, to use the crypto analogy, but the volatility is phenomenal because as soon as it goes up, it then sort of subsides and goes down a couple of years later because the industry in question is affected by macroeconomic changes. Mm-hmm. If I'm investing in a mining town and China imposes tariffs, the cost of production increases, I need to start letting the workforce go. It impairs the purchasing power of residents. You see price subsiding, yeah?
Yes.
And when it comes to the environmental effects, the holding costs increase, yeah? So it's not appealing to investors, which means that not both cohorts can't be competing for the same asset within those areas, i.e. investors and owner-occupiers.
Yep.
So I would say for long-term endurance and stability, one of the most important things to address is this, industry domain or industry diversification, as well as dominance of, exposure to negative environmental effects. And when you combine that with affluence, affordability, supply and demand, you're hitting the 7 or 8 year mark already.
Yeah, right. I wanted to ask about the affordability you mentioned as sort of one of the top 3 or 4. Are we talking about sort of local affordability, i.e. local wages to asset prices, rather than just like Darwin's cheap compared to everywhere else?
Yeah, it has to be contextual. It has to be contextual to be actionable. So let's say on our platform, we've developed an affordability index that's called also years to own, i.e. how long does it take for an average household to pay off a mortgage within a particular suburb?
Yep.
Yeah, and it's derived by looking at the typical price, looking at the median wages, looking at current cash rate plus 2% buffer, and then 80%, 50% of those median wages going towards repayments on an 80-20 LVR.
Yep. Yeah,
so it's like a mortgage stress indicator, if you will.
Yes.
So it has to be very contextual in order for you to understand, or in order for you to be able to action it. Because saying that Darwin is cheap is arbitrary. You need to link it to something. You either link it to, but if you start linking it to other suburbs, then you have to say, okay, but what is the purchasing power of the other suburbs? So you need to actually drill down and contextually embed it into the purchasing power of its residents to understand how affordable it actually is.
Darwin's probably a good case in that I don't have the data myself. It's more anecdotal, but from what I understand, prior to this investor run, the sales transactions were predominantly locals, owner-occupiers. I would say that that's flipped quite markedly, and there's an argument to say that there's probably a lot higher investor transactions than there are kind of domestic transactions. To me, that kind of speaks to kind of a baked-in risk for a market if it's only attractive to one side. And you kind of referenced that before, right? You kind of want both of those cohorts to be competing for those properties, because I think as someone that would probably for years identified themselves as a buy and hold person, I think it's different now when we have markets doing 20 or 30%. You can price in the buying and the selling costs, but for someone that is really wanting to think about that asset in terms of its function, i.e. when we get it revalued, we want it to be high. When we eventually sell it, we want to get the highest possible price. I don't think necessarily people think about that when they're transacting at the beginning, because they're not thinking about selling. But even when we get the property revalued, we're not doing it to sell, but we've got a valuer who's coming in with a sales lens, right? And then they would need to consider, well, what is the demand for this? And if the demand is only from investors, then it has to put a ceiling on the growth potential. Is that fair to say?
Yes, a couple of things there. Now, we really shouldn't discount the notion of reflexivity, which is in financial theory essentially a positive feedback loop.
Yep.
And think about it psychologically. If the owner occupiers were participating in the market and then you see an influx of investors, okay, and if it's still affordable for the owner occupiers, even though the investors have increased the pricing, one will pull the other.
Yep.
And you'll have a semi-FOMO effect. Just because investors are coming to the market, owner occupiers are not going to say, I don't want to purchase anymore, because they might know who's purchasing, but if they had an intent to purchase, they want to grab something quicker so it doesn't increase faster.
Yes.
So they're not priced out. So
Yep.
it's still going to pull them into purchasing and continued purchasing. Okay. But it still needs to remain affordable for them. So that's the first thing. The second thing is absolutely, there are markets where you see like too much speculation and too many investors entering the market, but there is a great proxy to determine that. I mean, I do think that it's anecdotal to say that it's mostly investors participating in certain markets in Darwin, because you don't see sharply increasing vacancy rates.
Yeah.
And that's what would happen. So why would that happen? If you have a lot of investors coming to the market, they're going to rent that property out to someone, yeah?
Yep.
And if they can't rent it out, the vacancy rates will increase, essentially. So, and they wouldn't be able to rent it out immediately, or the rental vacancies would increase because there's too many investors coming to the market, too many investors needing to rent out their property, which would manifest as a rising vacancy rate. Yeah. And if you see that in Perth, by the way, because that's how you see that there's oversaturation with investors. You see that Perth is at the peak of its cycle, essentially, or maybe coming down, because the vacancy rates, both short-term and long-term, have been increasing substantially. Yeah. So that's one proxy to use. Darwin is not yet there. But now the second part of, or the last part of that thing, absolutely needs to be factored in. So if I'm determining the aspect of steam, for example, and let's say I have very high levels of affordability in an area, I have a reducing supply, increasing demand, but I also see sharply rising vacancy rates. By the way, on a rented to owner population of 30 or 40%, which is already high, I would place a question mark against that. And you would actually usually see the short-term demand tapering off as well. And in that instance, I would say to myself, I maybe have 1 or 2 years.
Right.
That's how I would cap it, Now, if I have only 1 or 2 years and my portfolio strategy dictates that I enter a hotspot to extract equity to buy other purchases, that might be all good and well to enter that area. But then I need to consider, okay, if it has only short-term steam for 2 years, what will the area's performance be long-term? What is its volatility like? What are the annual averages? What is the industry centralization, diversification? What are these other things that need to be present there in order for my area, when it reverts back to the mean, at least reverts back to the average? And in that instance, for example, if I'm entering Darwin or certain areas in Darwin, and I only have, let's say, 1 or 2 years left, considering what I've just mentioned, I will pull out because I know that there's no long-term steam in those areas.
Yep. Yeah,
that's how I would look at it.
Yeah, that's interesting. I do want to ask you, because I feel like I'll get hate mail if I don't sort of say, ask you a question that we almost made fun of in the beginning, like which suburb has got the best potential? I'll let that marinate in your brain for a second, but I wanted to ask you a question about the future of property data in Australia, and because it does sort of seem like there's a lot of talk about AI. It feels like there's a bit of an arms race to come up with this grand unifying theory that has 100% correlation with price growth. There are some people saying and marketing that it's achievable. I mean, I even heard people nearly 10 years ago saying, well, I've actually developed something that says there's actually only one property in Australia that's going to grow higher than every other one. And I thought that was very interesting, and early time to talk about that. There are also other commentators to say it's far more complicated than people understand, and there is always going to be an aspect of crystal ball. And I don't mean the obvious ones like Russia going to war with the Ukraine, or like a conflict with China and America. I mean, those sorts of things are impossible to predict the outcomes. But if we are operating in a vacuum, they would still say there are too many variables and too much interplay to get to a point where we can actually say a computer has picked this property to beat every other property, or even a computer has picked this suburb and it knows that it will outperform every other one. I'm interested in your thoughts on that from behind the curtain.
Yeah, so great question. Now, the first aspect of that is the AI race. We are building, for example, our own AI agents, and we actually in at a point where I'm going to release, essentially it's going to be beta release, and it's going to be, essentially a really streamlined way of analyzing suburbs and getting information at a much faster pace. Yeah. So I do think that technology will help individuals moving forward to have access to the right information in a faster way. Yeah. So that's essentially a high level, what I do think. And I mean, technology in and of itself has been doing that for decades, centuries. Um, and but the other side, when it comes to prediction, think about this. In order for something to be an accurate prediction, you need volume of the same information. Now, I'm not going to speak out of turn, and I don't know what that individual or the company does in order to predict that that particular house will grow more than other houses. But in order for an algorithm or an agent, a large language model agent to predict something, it needs more instances of the same thing to occur and happen in order to recognize pattern. Prediction is pattern recognition. Now, how much pattern recognition do you have in isolated cases is my question.
Well, I think even from a macro sense, we're talking 500,000 transactions a year. I mean, in my head, that's a very low number for any model to reach some preeminent predicting ability. Is that unfair?
You in that instance, you would, it's neural networks essentially. So in that instance, it's not only the 500,000 that's happening this year, it's also the 500,000 that has happened for the last 2 decades, and you're trying to discern pattern from that. Now, the fact that it's at a different price level doesn't really matter, but you essentially need to have access to large amounts of data to put it into a model for it to make a prediction. Okay. Now, if you really think about it, there's nothing out there. I mean, Tesla is a data collection company. It's not a car company. It's a big data company. Yeah. It uses its cars to collect information about its users, to collect data, and to use that to sell additional products. That's what Tesla does. In the same way, the McDonald's is a developer, not a fast food chain. So essentially, you need a catchment. You need to collect a lot of data in order to make an accurate prediction. But because of the liquidity of assets and because of the variance of the variability of every asset that's within the same asset class, it becomes extremely difficult to predict the high levels of precision that my house will grow 3.5% more than the house next door. Now again, that's why I do think that all of that is a marketing campaign in my view, Mike. Any prediction, if it talks about certainty, I think it is they made too much of a leap, and anyone who's in the space understand that it's just pure marketing. I don't think that it will get there. I don't think it will ever get there, because what is the common denominator? The common denominator is a human being with a head full of thoughts that are incoherent in and of themselves, and that are irrational, emotional, and unpredictable. Now, the beauty of data is that you can aggregate decision making at a suburb level, and it's fine. It can give you a discernible pattern from which you can make a decision. But how about aggregating decision making on a portion of a street?
Yeah. You can kind of see where it kind of unravels. I mean, the mere fact that we are an imperfect organism needs to be baked into it, right? Because we make decisions based on biases. Even an analytical person like yourself admitted to a bias,
Absolutely. Yeah. It's. I mean, with property investing, though, Mike, it is a deterministic game in a sense that I'm after cash flow capital growth. That's what I'm after. Okay. And in being a deterministic game, it provides you with more avenues to actually have some kind of forms of predictions, But when you really, that's one aspect of it. But when you really go nuanced and you really go towards, should my windows be on the eastern side as opposed to the western or whatever, and because of that, it's going to grow more, You need large volumes of information to affirm that pattern. You need to train your models. In order for you to make predictions, the models need to be trained. And models are trained on volumes of data, of the same data, of the same pattern. So coming back to AI, I do think that it's also in the same way that you alluded to data-driven buyers agents, or essentially it's an overused term. I do think that AI is also overused, and we are in communication with enterprises as well who are trying to figure out how to use the AI and how it's going to help. I don't think the AI is completely a solution. I do think that there's a merging of the human and the AI where you still need to put it this way. In order for me to get the right output out of ChatGPT, I need to construct a good prompt, i.e. a good question. So if I don't have any understanding of nuclear physics and I want to understand the intricacies of nuclear physics, I will not pose the question to OpenAI, to ChatGPT, will give me a good answer. So in order for you to use the AI appropriately, yes, the AI has all of the embedded knowledge base and all of the information in the background, but how do you ask it to retrieve it?
Yeah, well, it's just calling a function, right? It's calling a node, and right now at this point in time, it's a fake intelligence, right? It's very good at speaking like the mathematics is very, very special, because right now it seems like AI I've heard an AI expert describe it to me very recently as AI is just kind of like dumb calculators, right? You have a prompt that has been taught to appear to be intelligent, but it's just calling functions. It's saying, okay, you want an image of something. I'm going to ask this thing, which is the secret source of OpenAI, for example, to generate an image based on the programming. But to say that it's artificially intelligent right now in terms of just the way they use ChatGPT, I think is a bit misleading, would you say?
Yes, it is misleading. It is just a faster way of accessing information.
It's kind of semantics too on what we term is intelligence. Correct. Right?
I was just about to say, and what is artificial as well. Yeah. So we're going into philosophy now, but essentially what think about this, why let's say, data platforms such as ourselves are positive, because your mind cannot compute all of the information at once. Yeah. And if everything is centralized and you can access it faster, the better for you. And the AI speeds that up a bit more. Now, when it comes to AI, and I've been building the prompts in the background for our AI.
Yep.
But it's based on my knowledge, on access information, on links, on nodes, on all of these other things. The input is as good as the output. Yes. So what it does, it retrieves the information in a concise manner for you very fast. And if you ask the right question, it gives you a really good answer. But it is a tool.
Yeah.
It is just a tool. That's all it is.
It's kind of no different to what we were talking about in the beginning, where, what's the best property for depreciation? Well, I can tell you the answer to that specific question, but it won't be a property that you want to be an owner of. Or, you can sort of say, well, what do you think about this suburb? But you can go like, would I live there? No. Or would I invest there? Yes. Or would I invest there for the long term? No. Would I invest there for the short term? Yes. It's the I suppose it's the question, right?
He needs the user and his or her information and goals and everything like that in order to provide an answer that can be addressed or acted upon. So, I do think that where the space is moving is great. However, I do think that at the same time, it's not going to be a solution to all of the problems. And I think that people who say that they will be, I just think they either don't understand how it works, or it is more just a promotional kind of, banner or brochure.
Yeah, they know that it's not possible, but they're marketing it anyway. There's a special place in hell for them, in my view. Now,
I do agree.
Before we get cancelled, I will finish up with that last question. And I know it's going to be a little bit of a stinker, but I suppose let me try and give you a little bit of meat on the bones so that we're not just repeating the same mistakes of a bad question. For someone that does have an investor sort of price point in mind, and let's just say sub 800, because the sub sort of 650 market is much difficult now. Let's say, or 750 or thereabouts, for someone that is wanting to accelerate themselves to be able to get that next property. They do need some front end growth, but they don't want to buy and sell this particular asset. It has to have some degree of longer term fundamentals, but the numbers are sort of starting to hum for you right now. Are there any herbs and spices that are secret you can share with us?
Yeah, absolutely. I do think I think that for that price point and for longevity as well as some, a good initial momentum as well within the short to mid-term 1 to 5 years, I think Victoria is standing out by far.
Yeah.
And I think that, in terms of shortlisting for that kind of a brief out of what is interesting, for example, and I'll give you an example when it comes to decision making for future. So for that brief, I will get a list of 15 or 20 suburbs. Out of those 15 or 20 suburbs, I would say 80% would be in Victoria. The remaining 20 would be in South Australia.
Right.
Now, the issue with South Australia, for example, and why that wouldn't be the top pick for me is that when you look at another metric where we have, it's called growth pattern deviation.
Yep.
Now, what is growth pattern deviation? GPD. It compares the suburb to itself. So it compares the suburb last 3 years of growth to 3 years of growth before that, last 5 years of growth to 5 years before that, last 10 years of growth to 10 years before that. And it's essentially, again, a long-term steam indicator because it covers 2 decades.
Yep.
And South Australia is a little bit dangerous in that sense because it's been outgrowing itself for the last decade at all time frames.
Yep.
So if I compare suburb A in Victoria, which has been lagging, and suburb B in South Australia, which has been pumping, let's say, and everything else is the same, the probability dictates that I'll choose Victoria. Mm-hmm. Yeah. So that's how you construct, the decision. So I would say Victoria, not just because the 80% of suburbs are P in Victoria for that shortlist, but I do also think that it provides, especially for that price point, it provides really good opportunities. Now, Victoria is becoming, essentially a tighter market in a sense that it's acting like a hotspot, but it's not generating 10+% growth in the last year. But it's steaming up definitely. We're starting to see 5% growth marks in the last year, which I call a transitioning area, an area that's transitioning between a warm spot and a hot spot.
Yep.
So yeah, that would be the answer. I think Victoria will be a good bet.
And well, I've had a few people talk to me about Victoria over the last little while, and there's plenty of commentators now, buyers agents on the ground saying it's absolutely going gangbusters. Whereas if we look at the market data from CoreLogic for last month, so I'm talking that would have been the close of the June month, we actually saw 0.5% growth, and even the year on year is 0.4 of 1% down. I wanted to ask you a little bonus question before I set you free. It's not showing up in the data because we're talking about medians for a whole city, but it's where the heat is. It's at that investor price point, which is actually sub-median. So if we shove a few thousand transactions sub-median price point, then purely by price segmentation, we're getting a big tip of the scale on one side. So we're not likely to see that hit the data unless the market starts being driven by those owner-occupiers that are buying over the median. Is that a reasonable explanation as to why we are seeing, say, Darwin pumping along in the median CoreLogic figures, but not Melbourne?
Yeah, well, Melbourne is a more diverse market. And you alluded to something, we speaking about Melbourne, Greater Capital City region as if it's a single market. And you have some suburbs that are excelling, some suburbs that are not excelling,
Yep.
And when you combine it together, because it's a larger market than a Darwin market, it sort of averages the year in, year out. Yeah. Now for Darwin, it's a smaller market, and those that perform extremely well, which pushes the price up a little, in terms of year on year. And I wouldn't say, is year on year for Darwin higher than Melbourne? I wouldn't say that.
I think year on year, Darwin's sitting at about 6.5%.
That's for the medium, yeah.
For the median, yeah. For houses, the year on year is 6.4 units at 5%, whereas Melbourne, year on year houses flat, and for units negative 1.3.
Yeah, so this is an interesting thing. For example, we have on the platform, we've developed our own metric called the typical price. We don't use mediums. Now, the reason why we did that is because mediums oscillate too much.
Right.
And it's very hard to determine and predict what's going to happen, Again, because we geared towards prediction, geared for growth.
Yeah.
Essentially, we need to develop metrics that are more astute and tell us what's going to happen. So, and if you looked at HtAG, you would see different figures for those two areas,
right.
So essentially, I think the answer is this. Melbourne is a more diverse and a larger market, and not every suburb is performing in the same way, and Darwin is a lower price point also.
Yep.
So Darwin is a price point 650 and below. Melbourne is 850 and below, and it's becoming very difficult in Melbourne to actually source a great asset for 650 and below these days. In a suburb that's really good. So, I think the diversity of the market and the fact that needle is not moved in every suburb is what's lowering the medium, essentially.
Yeah, interesting. Well, I mean, it's been a whirlwind episode. I've probably got you from twice the amount of time we had originally planned, but I'm just infinitely curious about this part of the world that you occupy, and thank you very much for doing what you said that you set out to do in the beginning, and just make the complex very simple, although I now probably have some more questions than I had in the beginning, but hopefully we'll get you back another time, Dr. Matt. But thanks very much for your time.
Mike, I really appreciate it. I really love the session. So, thanks a lot for the opportunity again. Really
Pleasure.
appreciate it.